Hello, this is Asa Graves, Chief Investment Officer at Graves Light Lenhart Wealth. There are several key points we hope you'll take away from this presentation, which you can access and save in hard copy form for further study. First, the U.S. economy likely experienced growth well above the long-term trend during the most recent quarter, which ended in September. However, economic and market indicators, which have signaled impending recessions in the past, keep us on guard with how we are handling client portfolios and wealth planning. Next, inflation has come down substantially over the last year, primarily in response to actions by the Federal Reserve. However, getting inflation down to the Fed's target rate of 2% may be difficult to achieve in the short term, yet we find parts of the fixed income markets attractive. Finally, for equity investments, we continue to favor small cap value in international stocks. This preference is largely driven by relative valuation levels. Economic data received so far point to strong growth for the U.S. economy during the third quarter. The Atlanta Fed District compiles a GDP Now estimate based upon economic reports which have been published to date for a given quarter, which is shown by the lime green line on the chart on the left and is much stronger than surveyed economist estimates compiled within the blue chip consensus. The bond market appears to be reflecting economic strength as well. The chart on the top right shows the premium or interest rate spread the market is demanding for high yield, also known as junk bonds, and the lowest rated segment of the investment grade corporate bond market. The blue line, which has widened somewhat lately but remains below the levels reached earlier this year and is well below the historical average of 5.5%. If the market was worried about the repayment stream from the bonds, the amount of interest demanded would increase. The green line represents bonds considered high grade but at the lowest end of the investment grade spectrum, often referred to as BAA rated bonds. The message from this credit segment also points to the market's assessment that current and future repayments to bondholders will not come under stress. The bottom chart on the right shows the S&P 500 price and the associated forecasted earnings per share or EPS estimates for the next 12 months, which is shown by the dark line. We've placed a red arrow to highlight that the forward EPS estimate is turned up, which signals expected higher profitability associated with economic growth, seemingly confirming the bond market's outlook. President Truman famously said, "Bring me a one-armed economist," because he was tired of economists telling him on the one hand, quickly followed by a caveat on the other hand. For better or worse, I'm going to use my metaphoric other hand to express our concerns which may impact future economic growth. One of the best recession indicators is still in play, as the yields of short maturity bonds are higher than those of long-term bonds, signaling unusual credit conditions which have preceded, if not helped cause, subsequent recessions in the past. On the left of the page, we've included snips of a study from the San Francisco Federal Reserve District, with the blue line of the graph showing the difference in yield between the 10-year Treasury note and the 3-month Treasury bill. When the 3-month Treasury bill has a higher yield than the 10-year, the line becomes negative, which you can see has occurred prior to recessionary periods shown as tan bars since 1955. Typically, this signal has had a lead time between 6 to 24 months, with an average of slightly more than 12 months. Importantly, the chart on the upper right of the page shows the current yield curve, which is represented by the green line linking the yields of the various maturities, with the shortest bonds enjoying yields more than those of longer-term bonds. However, the important point is that the yield environment 12 months ago was different and had not yet inverted at the shortest end, shown by the yellow line. This means that the signal has not been in place for a full year, leaving the flashing light on, if you will. Other sobering points which could weigh upon future economic growth are shown on the bottom right, which is not meant as an exhaustive list. The good news is that inflation is slowing across many metrics. The bad news is that inflation is most commonly judged on a year-over-year basis. This chart shows how a range of monthly inflation readings will be incorporated into year-over-year rates over the next several months. We've included an arrow to highlight the purple line, which represents no change in prices versus the previous month. Even if this dramatic slowdown in price pressures does occur over the next few months, the year-over-year rate will accelerate through the end of this year and will only meet the Fed's 2% annual growth rate around the beginning of spring. Here we see illustrated the yields on various fixed income instruments. The blue diamonds are the current yields, and the gray bars are the range of yields for the given instrument over the last 10 years. In general, yield levels across the fixed income universe are offering near, if not the best potential returns offered over the past decade. We currently favor bonds, especially those with their yield circled, for their diversification, capital preservation, as well as upside opportunities. We have started to take advantage of the run-up in rates and lock in the returns to maturity for longer maturity bonds. Lastly, we note that high yield or junk bond spreads relative to treasuries have tightened to levels which are less than the long-term average. As a reminder, these spreads represent additional compensation for the inherent default risk of risky companies compared to safe government bonds. While overall yield levels appear relatively high, these tighter spreads or less compensation for potential risks warrant increased caution. There are many important distinctions between stocks and bonds. One of the most foundational for investors is how each of the asset classes provide a return on investment. This slide focuses on the fact that the coupon, which is the periodic receipt of income paid to the bondholder, comprises the vast majority of an investor's return over time. The chart in the upper right depicts the composition of bond returns over the past 3 decades. Note that the blue shaded area, which represents the income received, dominates the total return column for each decade and cements the overriding importance of bonds' income payments to bondholders. The chart in the bottom left breaks down the Bloomberg Aggregate Bond Index, which can be thought of as the S&P 500 of domestic bonds. Over the past 5 years, which is one of the worst 5-year periods for bonds in history, the price-only component of the index, depicted in the lower line, fell approximately 13%, which is terrible for one safe asset. However, the income received over the same time period added 13%, shown by the top blue line, which provided for a slightly better than break-even experience. The chart on the bottom right illustrates the same dynamic, but with bonds with shorter maturities of up to 5 years. The indices for both shorter-term government securities and corporate bonds both lost approximately 5% in price, but the income received pushed the return for bondholders comfortably into positive territory, with the corporate bond index achieving a total return of almost 9%, as shown by the upper light blue line. The takeaway is the income received from bonds largely determines the associated investment return. As a side note, this dynamic can be difficult to determine from custodial statements, which show ending prices for each relevant period in one section of the statement, with period income received shown in other sections. The S&P 500's valuation remains elevated across several valuation metrics relative to the previous 25 years, as shown in the graph on the left. Of note, the S&P 500 is more richly valued when compared over longer time periods. Importantly, the Magnificent Seven large tech stocks are largely responsible for the elevated valuations. As shown in the chart in the upper right, the combined market value of these 7 stocks would represent the largest single sector in the entire S&P 500. Furthermore, the aggregate market capitalization of these 7 stocks outweighs the combined market value of French, Chinese, UK, and Japanese stocks as shown in the lower right of the slide. If history is a guide, the winners of tomorrow will likely come from smaller U.S. companies and those based in economies outside of the U.S. This slide continues the theme that we believe investors' infatuation with the 7 largest stocks is leading many to miss the attractive investment opportunities outside of the U.S. The chart on the upper left shows a tremendous historical price outperformance of U.S. tech stocks versus the rest of the world, which is now well in excess of any period since 1950, including the dot-com bubble. The chart in the lower left compares the long-term valuation between the U.S. and international stocks based upon the cyclically adjusted price-to-earnings ratio, or CAPE, which shows international stocks are trading in line with the bargain relative levels last seen in the 1930s and mid-1960s. Lastly, the table on the right shows the estimated revenue and earnings per share, or EPS growth, for international stocks is very similar to the relevant estimates of U.S. growth. Nevertheless, international stocks continue to trade at much lower valuations, which could provide superior future returns. Current high yield spreads are around 440 basis points, which is below the long-term average, implying investor confidence that the associated interest and principal will be paid on time and in full. Historically, small cap PE ratios tended to be around 15.4 times in such an environment. However, current PE ratios for small cap stocks are around 12 times, which is historically cheap. This is an interesting incongruity, as smaller companies and those with lower credit quality typically react more similarly to changes in economic conditions. We believe small caps have the potential for outsized future gains as conditions migrate back to historical norms. Commodities performed well during the recently completed quarter, with the Bloomberg Commodity Index experiencing an increase of almost 5%. After substantially decreasing commodity exposure during the first half of last year, we continue to include a relatively small commodity position in client-blended asset portfolios to help fight unexpected inflation. Importantly, we are focused on broad, diversified commodity exposure instead of focusing upon a single segment such as gold. As shown in the chart to the right, gold is historically expensive once inflation is factored in. This helps explain gold's disappointing returns over the past few years in the face of global unrest, worries over governmental finances, inflation, and other issues which many thought would have led to a jump in the price of gold. We've included a box within the chart to highlight that gold's current inflation-adjusted valuation has led to negative 5-year returns in the past. Thank you for your time and interest. We hope you found this information useful and you are more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. As always, we're here to help.